Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Want to take a look at McDonald's this morning. Stock is up 4.2% as of right now, even though the earnings they released this morning weren't all that impressive. I think part of the reason it's up today is because the stock was down almost 15% year to date before earnings. So investors are just kind of looking at it and saying maybe it was a bit underpriced, despite the fact that the earnings are a bit disappointing. Because at the end of the day, this is an awesome company. How they manage their business, what they do. This is basically a real estate company masquerading as a restaurant, and I'll talk about it in a second. But at the end of the day, if you are looking for a company that's going to pay you a dividend, raise that dividend every year, be consistent, McDonald's does a pretty good job of doing that while giving you some extra upside in terms of share growth and EPS growth. I do own some shares of McDonald's in some portfolios I manage. Again, these are for people that are closer to retirement, but it is a stock I'd even be interested in buying if it dropped a little bit more. So I'll look at valuation at the end of the day because I do think McDonald's is a company that is here to stay, even if there have been some missteps in how they've managed their business in the last couple of years. So if you look at the results themselves, comparable sales down 1%, first time since Q4 2020 that's metric's been down, and that's not a good sign. Kind of shows that they've missed a little bit on the pricing aspect. McDonald's has always been kind of the value play in the fast food space. You go there and you feel like you've gotten a good value. I don't really know if that is the case these days. I think consumers are looking at some of their prices and kind of staying away, especially when you compare against some higher quality fast casual places that are out there and still growing at a pretty decent clip. They can kind of say that, hey, we're losing the consumer that's mid to low income, that people are struggling, they're staying at home more often. But are they staying at home more often, or are they just going to other places? That's kind of the question, because companies like Cava, Chipotle are still seeing pretty significant same store sales growth, and McDonald's is now on the shrinking end. And I think a lot of the news around, hey, Big Mac meals in the high teens, expensive burgers, a lot of the ideas that they've had around hiding some of their values and some of their promotions within the digital app that only gets about 25% of their consumers is kind of alienating some of the people that aren't using the app yet. And yes, eventually more and more people will move to the app, but what about those people that just come into the restaurant, look up at the board and see something that is very, very expensive, and they're never going to come back again because they think the pricing is way too high. So I think they really have to do a couple of things in order to right the ship, and a huge focus has to be on affordability. And I think if you look at some of the recent promotions, that $5 promotion, I think they're doing a €4 promotion in Europe. So they're doing a lot of stuff that's focusing on affordability, that's making people get back into the stores. And based on their call, they're already seeing results in terms of people moving into the stores, but they're not really seeing the results yet in terms of the dollars actually going up. So people, in terms of the amount of people that are coming into stores, those promotions are working. Are they going to work in terms of raising their overall revenues? I am not so sure. That remains to be seen. So why is McDonald's such an awesome business model? Well, because it's not really a restaurant the way you think about it. So yes, they are a restaurant. They own company operated restaurants that, they have people that they staff restaurants with, and they manage those restaurants themselves. But that's not the majority of their business model. There are 42,000 McDonald's locations worldwide, and only 5% are managed by McDonald's, the company. And they do that because they want to make sure that they're testing stuff out. They want to make sure that certain promotions are doing well, that certain new items are doing well, etc. So those are really like test restaurants for them. But the majority of their business is actually on the real estate side. They go out there, they look at locations that might be good for a restaurant. Majority of time, they buy that location. Sometimes if they can't buy it, they lease it. And they partner with a franchise partner in order to build a restaurant on that location. And then they kind of move away. It's like, listen, we trust you to do the right thing. You're the franchisee. You're managing the restaurant yourself. Because we gave you the right to manage this restaurant, because we gave you access to our brand name and all of our products, we're going to charge you a fee. And because you run your restaurant on our land in a building that we own, we're going to charge you rent for that. And that's kind of their business model. They are a landlord, essentially. They are a landlord that charges franchise partners a franchise fee on top of the rent that they get. And the reason that's awesome is because they don't really have to worry about all of the management aspects of the restaurant. They leave that up to the franchise partners. Obviously, they have to choose the right franchise partners because their brand name must be protected, and they do a good job of that. But because the cost outlay on something like that isn't as big as operating a restaurant, the margins are so much better. So in a company operated restaurants, which is about 5% of their locations or about 2,000 locations worldwide, their operating margins are maybe 10 to 15% tops. And that's consistent with other restaurants in the business. On the franchise business, where they make less revenue because it's only rent plus 4% of overall sales, the operating margins are close to 70%. That's awesome. Nobody else comes anywhere close to that. If you look at operating margin for McDonald's, you're talking about overall operating margins in the 45 to 50% neighborhood. If you compare that to almost any other restaurant, you're doubling them, if not tripling them. And that's because their business model isn't really running the restaurant. Their business model is having a restaurant brand, owning the land that the restaurant sits on, and getting a fee for allowing other people to run those restaurants. And that's why McDonald's is a freaking awesome business. That's why whenever I look at the stock, I look at it and I look at it, wow, this thing financially is great. It's great. Even during the pandemic, their sales only shrunk about 9%. And that's because, hey, you're probably still collecting rent. And yeah, if worldwide sales at your franchise partners drop, that is obviously going to impact your revenue. But at the end of the day, you're still doing okay as a business, even if things slow down a little bit, because rent is going to happen unless there's a massive economic crash and suddenly your franchise partners can't pay you any rent and sales drop to zero. You're probably going to do okay. And that's why this stock is such a interesting buy for somebody who wants kind of relative safety. Even during 2009, the stock still generated a ton of net income, still generated decent revenue, even though it shrunk a little bit during 2020, a little bit of shrinkage, but then growth right away. If you look at their stock price, again, this isn't something that's not going to drop when a recession happens. It will, but it's probably not going to drop as much as the rest of the market because of the way their business model works, because of how they do business. They can really stomach a lot of things because their business model isn't necessarily operating the restaurant. They do still have to make sure that those restaurants are operating at a high level and that the franchisees are doing well, because otherwise new franchisees won't be interested in running restaurants. And that's really their business model. So they do benefit when franchisees are doing well, on top of the fact that, hey, we get more rent because more franchisees want to get into play, but we also are collecting 4% of system-wide sales as a franchise fee. And by the way, on any new restaurants starting this year, I believe in the United States at least, that 4% fee is becoming 5%. So that is only going to serve to improve margins for a company like McDonald's. And that's one lever they can always pull to improve their margins. Hey, suddenly, guys, I know you guys are franchise partners. You've been with us forever, but we need to make a little bit more money. We're going to take that franchise fee and bump it up 10 basis points. It's not a lot, but 10 basis points across billions and billions and billions of dollars of system-wide sales is a huge amount of money flowing down to the bottom line. And that's why this business is as awesome as it is. And that's why whenever this stock kind of drops into that 4.5% free cash flow yield range, I sort of start getting interested in taking a look at the valuation of this company. So let's look at valuation in general. Again, this video purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence before investing. So valuation, McDonald's, company that's probably buying 3 to 4 billion in shares any given year. They do have a decent amount of debt, so that's something to keep an eye on. But their debt is low interest. Again, this is McDonald's. People are going to be willing to rent them, borrow them quite a bit of money at a relatively reasonable yield. So I'm not super worried about that. They are a dividend payer, a consistent grower. In the last 2 or 3 years, that dividend's grown at 10%. But when I look at this, I think that's going to come down a little bit, simply because their growth is coming back down a little bit. One of the worries about the stock, one of the reasons it's down, almost 15% before earnings, was that growth is starting to slow a little bit. And the question is going to be, well, how do they improve that? How do they get back to growth? How do they attract that lower and middle income consumer? And I think a lot of that has to do with lower prices, higher volume, because I think they've outpriced themselves a little bit from the space that they should be in. They can't have higher prices than something like Chipotle. It just doesn't make sense. Chipotle is higher quality food. People are going to go there over McDonald's if McDonald's is more expensive. McDonald's has to be a better value, has to be a better and lower dollar cost than something like Chipotle, than something like Cava, than some of these competitors. They really have to get back to the roots. When I think about McDonald's from 10 years ago, when I used to go there, it's like the food tastes good. It's not the highest quality stuff, but hey, it tastes good and it's cheap. Now, when you think about McDonald's, it's like, hey, the food tastes good, but it's not that cheap anymore. So I think that's something that they have to fix. They have to kind of work on their brand name. They have to work on their affordability. If they really want to stick to this, hey, all of our best deals are in the app, in the digital app. They have to get more people into the app. That's the reality of the situation. Like if only 25% of the people are seeing the promotions you have out there because they're all in the app, that's a problem. That's going to make your brand worse because 75% of the people are suddenly going to think you're getting too expensive. You have to fix that. You either have to get more people into the app or just lower prices outside of the app to make the 75% of the people that are the majority of your consumer base be happier with your prices. I think that's what they have to fix and that's what they have to work on. And I don't know if I heard enough about that in the call to make me feel comfortable that this is going to grow at a faster clip than, 2 to 3% any given year. Because even now, like I'm kind of concerned that 2% is within reach. When you hear their call, they said that July is not really doing that well either. So we're seeing more people come into the stores because of that $5 promotion, but they're not really spending more money because they might just be buying the $5 promotion. We have to get more people into the stores and we have to get them to spend more money. So how are they going to do that? That's up to you to decide as an investor. But in my mind, I think this is a company that's going to start slowing a little bit in growth, and you have to be comfortable with that while working a bit to improve their bottom line. I think one thing McDonald's is doing pretty well is they're becoming more automated. You kind of go into the store, there really isn't anybody to order your stuff from. You order it from a machine, and maybe some people don't love that. But I think from a bottom line perspective, from an investment perspective, that does all flow down to the bottom line pretty well. And I think they have to figure out ways to not only get back to growth, but also improve margins. And I think, me sort of assuming that they're going to get to 30.5% margins at the end of the day here isn't all that aggressive, considering the starting point for some of these estimates are 31%. So I think I'm being pretty conservative here in my assessment of McDonald's. When I look at it from a valuation perspective, I'm assuming that the dividend is going to grow at 6%, that 30% of their free cash flow, which is about $41 billion in the next couple of years, is going to go towards buybacks, which is kind of in line with what's happened in the past couple of years, that the free cash flow yield on a future basis is going to be about 4%. And with all that in mind, and I'm plugging in at a 7.5% target return, which gets me to about 10% with the dividend, gets me to a fair value of about $232. And I think that means that where it's priced at today, or where it was priced at this morning, before it was up about 4%, is kind of fairish, in the realm of fairish. That means that at the 262 that it's trading at right now, about a 7.5% weighted return, which, given where the market is priced at today, kind of probably realistically in line with the market. I'm not expecting the market to return anywhere close to 10%, given where the market is at right now. I think there's potentially some upside here. I'm potentially being a bit conservative. If they can return to growth, potentially a little bit of upside from here. You can kind of play that out here yourself. Just hit file, make a copy if you want to use this spreadsheet. I think there's some upside on the margin side. And I think the reason for that is that this business is very malleable. I think this business is something that they can switch really quickly because of how it's set up, because of the franchise setup of it all. They can raise franchise fees to improve margins. They can potentially introduce new restaurant concepts like that McCosmics things. I don't know if that's going to be all that successful, but they have the flexibility to do so because this business is so consistent. This is a business that's going to generate, $7 to $8 billion of free cash flow every single freaking year. They're going to pay out $4 to $5 billion of that in dividends, and then they have $3 billion to do whatever they want with. And remember, that free cash flow is after they already open up another 1,500 restaurants every single year. So you're going to get 2% net restaurant growth, maybe 1 to 2% same store sales growth, and that's kind of getting you to that 4% revenue growth that you're aiming for as an investor in McDonald's. So it's not going to blow the doors of your investment thesis, but if you're getting 7 to 10% returns from a company like McDonald's, I'll take it, especially if it's something that I'm pretty confident is going to continue raising their dividend at least 5 to 6% and give me a yield on cost of 4 or 5% a decade from now without a huge problem. And that's from the perspective of somebody who just kind of wants income and doesn't really care about price. From the perspective of myself, who's more concerned about long-term returns and total returns and all of that, I'd probably want a better price than it's trading at today, maybe even a better price than the 232. But for me, if this stock were to drop into the low 200s, would I buy a lot of McDonald's? Totally. If it dropped into the 230, 240 range, would I buy it for people who are more focused on dividends? Totally. If it's trading at 260 right now, would I still be interested in it? Yeah, it's not a bad deal. Seems like an okay price point. I'm just kind of waiting to see what management has up their sleeve, and I don't think this earnings told me enough to feel comfortable about making this a huge investment at this price point, because there's still a lot of uncertainty around short to midterm growth, given what they've done with pricing, given what they've done with product, given what they've done with their strategies. I think they kind of misplayed it a little bit, but because this is a fantastic business model, they can misplay it quite a bit and still have this be a pretty good investment. So that's my take on McDonald's. Let me know what you think. Do you agree? Do you disagree? Leave a comment down below. Are you a buyer, seller, etc.? Bye.